Manisha, let's understand first what RBI is trying to do here. Look, their surveillance mechanism has seen very large radical changes. So because this entire surveillance mechanism has seen big changes where there is one department and no big separate, earlier they had a separate department for banks, separate department for NBFCs, everything has been clubbed together. So obviously in terms of the data and with the use of AI, RBI is able to access data. But why is RBI acting? The reason why RBI is acting is very simple. They are simply trying to protect public interest here. They are ensuring that the regulatory framework is not compromised, and they are ensuring that wherever there are concerns, there is a penalty which really needs to be imposed. So RBI is simply ensuring that there is no lapse when it comes to the regulatory framework, and I think markets should actually be happy about it, that the regulator is in a sense doing what is the fiduciary duty. So I know a lot of folks have started talking about it, why now and why suddenly. Well, it's not why now, why suddenly. There is a 4x jump if you really look at the data in last couple of years. Now specifically about banks versus NBFCs, well, you can make a case that for NBFC, if they do not really stick to the guideline, and if public and corporate governance standards are compromised, then obviously they will have to face the regulatory pushback. I think that in some cases here, a lot of problems are not structural in nature. Those are minor lapses, and those minor lapses could be fixed. But if those minor lapses are not fixed, that in the near term, NBFCs in a sense will continue to see what could be called as PD rating. Now, if NBFCs are losing, will banks gain, or will this something is something I'm not so sure. So just because NBFCs are coming on RBI's radar, that does not mean banks in the near term should benefit because of that.